Okay, very good morning. It's Thursday the 12th of October, so I hope you're well. And I think probably prudent to start with what happened last night, getting you up to speed with the FOMC minutes and the ensuing reaction that we've seen so far this morning. And obviously, as you can see on my charts, gold on the top right hand corner is reapproaching the $1,300 psychological handle on the upside. We've had a bit of a pullback in the major pairs, but as you can see last night, the reaction was one of dollar weakness. And into the close on Wall Street, we did manage to just about squeeze out fresh record highs again as far as the S&P is concerned. Equity markets have kind of flattened out since then, but looking at bunds still remaining a little bit bid this morning, up around 20 ticks or so. The US 10-year up also around 5.5. And as I said, gold elevated, but the currency move just being paired slightly. So it's a fairly quiet open overall, but as you can see, there's been a moderately dovish interpretation of what we heard from the FOMC minutes last night. Now, for those that did stick around, we were covering it last night. Obviously, in retrospect now, looking at like the move in gold, which was trading at the time around 1287. So it's seen, an approximate $12 move now in its total size. But at the time of release, it was particularly tricky to trade, and I'll go through why that was, and then probably why there was an underlying interpretation of dovishness. Now, just looking at the euro-dollar chart here firstly, and just putting it onto a minute candlestick, because I just want to show you the way that the market originally reacted. So these are obviously each bar representative of a 1 minute time frame. So you can see here the initial reaction. You've got a price swing of about, I guess, 25 pips. The following minute, a slightly lower degree of volatility, but again, quite volatile price action. Then it kind of edged up, came back down. You can see that, as far as the euro was concerned, it would have been a bit of a mess to try and trade that activity. But over the longer run, you can see that really the more cleaner move came at 8 o'clock. We started to see another big concerted push. That was when actually the equity markets, the kind of cross asset class correlations started to fit with this kind of dovish move. This is when gold and equities started to rise again, and the dollar started coming under some pressure, and then you started to see actually a bit of a better move. And this was, we're talking about 8 minutes past 8 at that point, London time in the evening. So it was a good over an hour after the initial decision. So, I don't think you could have predicted that that would have been the case, because at the time of the release, it certainly was not that much of a tradable event. The little flurry higher that we had in the equities was particularly short-lived when the information did come out. If I actually circle here on the S&P where the announcement was, this was the actual reaction. That center, that extension on that high wick there was the volatility. So there was a brief blip higher before it came all the way back, and it took an hour later before then we started to really ramp up into the close of Wall Street. Now, what I wanted to do was show you this screen, because some of you might not be familiar what this looks like, but this is basically a snapshot of Bloomberg, and this is how the comments would come down. So if you're a trader on your Bloomberg terminal, or you are looking at it to see the comments all come out in real time, then this is basically what you see. So as you can see, there's about 15 comments in total. These are the kind of sentences cherry picked out of the minutes document themselves. So what Bloomberg deems to be the most important. Now, of these, as you can see, there's 2 at the top which are highlighted in red. And these are kind of formally known as the stickies, because when all these comments drop down the news wires at 7 PM to the second, basically everything drops below it, but these 2 will stay stuck at the top of the page, just to make it easier for the user to read the main headlines. Now, the first headline actually that dropped down, you'll see here, was many Fed officials are concerned low inflation not only transitory. And so hence the reason why the initial reaction was a dovish one. But then a second later, the second headline, many Fed officials saw another rate hike warranted this year. So again, we knew going into this event, inflation is the real critical area of which people are trying to monitor to gauge the confidence the Fed have in tightening going forward. And so you saw the first one, which is dovish, the second one is hawkish. Hence you get that indecision in the immediate aftermath. Now if you start going down the list, this green headline down the bottom, several Fed officials said the hike should hinge on incoming data. It's kind of on the balance. This data dependency kind of theme is one that's been a kind of a common one from the Fed in recent years. However, I guess if inflationary conditions were to get worse, if non-farm payrolls isn't weather impacted, and the second reading that we get at the, next month, if it was equally bad, then obviously this could push them off track. So possibly that being also slightly bit dovish as well. But so this is the way the comments came out, and I guess reading between the lines, this is what most of the newspapers are writing about, and this would probably help explain some of this interpretation of it being on the margin more dovish. Inflation cloud hanging over the Federal Reserve. The central bank holding course for the end of the year rate rise, but worries about the risk of stubbornly low inflation continue to hang over the Federal Reserve's policy meeting and their officials and their decisions. I think the best way to sum it up here was a direct quote from the minutes themselves. Many participants expressed a concern that the low inflation readings this year the low inflation readings this year might reflect not only transitory factors but also the influence of developments that could prove persistent. So this is kind of what I'm referring to when I say that their confidence is kind of dwindling, if you like. It is still, they are confident enough, but there certainly are some signs that if things should change, and as they said themselves, economic data was to weaken, then certainly it could push them off course. What does this mean then for the actual probability of the interest rate hike to be executed in December? Well, this is the federal funds rate futures, and as you can see, a December rate hike, I think when we were looking at this number yesterday, it was something like 91.8%. It is now 81.7%. So a December rate move is still heavily expected by the market, albeit it has come down just a touch from where we were this time yesterday. There's been a couple of Fed speakers as well, just to make you aware. You've had Fed's Williams spoke last night, said that it's appropriate to raise interest rates gradually and that he sees one further hike in 2017 and 3 in 2018. Said that the Fed had not only reached the full employment mark, we've exceeded it, and remains optimistic core PC inflation should rise to 2% over the next couple of years. So as you can tell then, his kind of favoured leaning is more on the hawkish side, albeit being a soft hawk by definition. Esther George, the Fed is meeting its dual mandate, and she called for a gradual rate hikes. And then Bostic, the US economy appears on a solid footing and sees inflation to drift up to 2% over the next 1 to 2 years. So as you can see here, the full kind of all speakers erring on the side of just a clarification about December. Now obviously, knowing your hawk-dove scale needs to be taken into account. If you think about the people we've just talked about here, so you've got Bostic here, which is slightly neutral to dovish, and then you start scaling down. Williams of San Francisco Fed, seen on a more hawkish side. Esther George is the most hawkish, but she is not a voting member on the FOMC until 2019. So the markets do listen to her, but given her outlying stance and the fact that she's not a voter for about another 2 years, it's rare that really she moves the market, so to speak. The other one that we had, of course, yesterday, which might well help a little bit of the push for the dovish reaction to the minutes, was Fed's Evans. But keeping in mind, Evans, the Chicago Fed chief, definitely sits on the other end of the spectrum more on the dovish side, but as you can see here, the tick is a voting member of the FOMC right now, and Evans said it's too early to make a call on December rate hike. So there is a bit of a split of opinion here at the moment, which is understandable given the broad spectrum of views that are present on the hawk-dove scale. But it's going to be interesting to see, obviously, the communication that comes nearer the time of the actual event itself. As you well know, one of the probable big hurdles the Fed will have to judge at the time is the US debt ceiling, because as you know, the debt relief that was issued by the federal government for financial assistance for the impact of Hurricane Harvey and Irma was wrapped up into the kind of the short-term bill on the debt ceiling, but that only takes us through to pretty much right at the point of when the Fed will be making the decision about their December hike. And so that definitely is a big tail risk to their decision, whether or not they'll be able to go ahead with it. So overall, net, I would say in summary, this has not changed what the Fed are going to do at this point, at least. In terms of the short-term market reaction, as you can see, some of the assets are holding on to a slight dovish interpretation, but already this morning the dollar started to pair some of that move, and so consequently major pairs here in the top left-hand corner have started to come under a little bit of pressure. Gold, though, still remains elevated, and certainly that $1,300 handle needs to be watched, but for the equity space, really this doesn't make any difference, I would say. We are still just sitting up at these all-time record highs, as we have been for the bulk of the week. Busy calendar, though, for today and tomorrow. Could shake things up considerably from what has been relatively quiet thus far, and we'll have a look at that in a second. Looking elsewhere in the other headlines to be aware of, this is what the other news services are talking about. Today marks the conclusion of the 5th round of Brexit negotiations between Britain and the EU, and to summarise this up, basically we're completely at a standstill. I think summarising up, one official directly involved in the process said there was nothing, zero, no progress. I think that's about as definitive as it gets. We talked about this earlier in the week. I feel as though the reason why this 5th round has gone particularly stale, if you like, is because Theresa May has had to realign her support by sounding more authoritative to get the Brexiteers back online after her pretty abysmal Tory conference performance. And so while she tries to get her own house in order, it comes to the detriment of the European talks, because sufficing the sentiment domestically, she needs to be more hardline, which is obviously a negative when it comes to dealing with Europe and the negotiating table. So the 5th round's going to conclude today. I would be of absolutely no surprise if you start to see comments from Barnier and so on saying that no progress has been made, disappointed about progression so far. Do I think that's going to move the pound today? No. It's kind of, that's what the status quo is at the moment. So this is kind of a little bit of a longer, slower burner, but certainly something which is simmering in the background and definitely will start to become more important the longer these talks go on. Okay, looking at oil. Firstly, let's just have a look at the oil chart quickly, because there was a pretty decent move actually last night on the back of the APIs. If you remember, these are a day later than would be normal. This is due to the Columbus Day holiday on Monday, so we'll get the API, we had the APIs last night, we'll get the DOEs later this afternoon. But this was the actual reaction here, so from about 51.33 and the candle closed at pretty much the 51 handle. So a decent 30 cents move, and I'd say for the APIs that's on the bigger end of the spectrum of movement. Now, why did that occur? Well, if you haven't caught up with the numbers from the APIs last night, let me just briefly recap them for you. We were anticipating a drawdown of 2.4 million in the headline crude figure, and it came out at a build of 3.1 million. So we had a considerably larger build when markets were anticipating a larger drawdown. So surprise on that front, obviously bearish. Cushing, a build of 1.216 million. Notable because it's the 8th weekly build in a row for Cushing. Distillates, the biggest build in 5 months, just above 2 million. The only figure, I guess, bucking the trend slightly was gasoline, with a draw of just over 1.5 million. Expectations were for a build of 200,000, so that in isolation would be a more bullish figure specifically for gasoline. But overall, I think the headline, given it's such an outlier, kind of weighed on prices, and here we are just sitting right at the $51 handle, which is pivot today. So that will be your reference points for trying to navigate the data when it comes out later. Talking of the calendar, let's have a quick look, and really it's going to be, as really has been the case throughout the week, it's more of a US oriented sessions that we're looking at. And so European data is fairly light this morning, but then when we get into the afternoon, things start to get a lot more interesting. Not only because we have PPI data from the US, we get the DOE all inventory numbers, the nat gas storage change, the weekly jobless data, but check out the speaker schedule as well. So we kick off from 3:15 and we have Fed's Brainard. So remember, let's just jump back to the hawk-dove scale. Brainard sits right on the dovish end of the spectrum, Kashkari being the most, but Brainard is certainly on that side of the policy thinking spectrum. And then we have Fed's Powell. Now Jerome Powell, from most market participants that I've been talking to or listening to pundits talking on Bloomberg and so on, I would say Jerome Powell seems to be the person which most people are now tipping to become the replacement of Janet Yellen. Then we go further forward. ECB's Draghi is taking part in a panel discussion, rethinking of macro policy conference, 3:30. ECB's Prayat speaking at a separate event. Bank of England's Haldane speaks later at 6:45. Now Haldane, an interesting chap, the chief economist, although he hasn't, let's say, crossed over to the dark side with Ian McCafferty and Michael Saunders. He certainly is intonated that he could sway on a more hawkish side for some of his most recent speeches. So I would be particularly interested, if you were looking at sterling currency, to see what Haldane has to say, because we're at obviously this very key rock and a hard place between that of inflationary pressures at a point of, will the Bank of England need to act even as soon as November, or is this going to be a case of the political uncertainty will outweigh that argument? And so Haldane will be one to watch. And then you've got other speakers which are much later into the afternoon. So that's part 2. Part 1, economic data, US based predominantly. Speakers certainly afternoon in terms of the focus. And then also early afternoon you get the first of the 2 big banks to report. Now, earnings season has already been underway, but it's kind of gone under the radar a little bit. It doesn't really start to ramp up until the big banks start to report, and JP Morgan and Citi will be the first of which to get those underway. And so, just to remind you of a website that I use for these types of events that you might find useful yourself. This is called, this service, Celerity Global Insight. And this is their event-driven intelligence portal. Now, this particular section just looks specifically at single stock earning previews. So what my kind of routine would be 2 days before, usually 2 or 3 days before, these guys will basically put out a preview, as you can see here, JP Morgan and Citi. So if we have a look at JP Morgan, because they'll be the first one up, basically what this provides you is the specific timings, when it's going to come out. It also gives you outliers and strategy, key measures, so it will look at what is the street looking at for kind of key metrics, earnings per share, EPS X items, revenues. It will also give you a bit of a flavour for what analysts on Wall Street currently have as their outlook for the stock, whether buy, hold or sell ratings. Recent news headlines that have come out can be also useful to add a bit of context, particularly if they front run a little bit of news, whether positive or negative. It will also provide you with a technical breakdown of the single stock itself, as well as then a summary overall. And it does this basically in this kind of detail for every single company that reports. So if I just click on Citi, I get exactly the same thing. So just like you would approach major economic data, you do the same thing with corporate earnings. You get prepped up in advance to know exactly what it is that you're looking out for. Now, in terms of these earnings, looking at what analysts at Deutsche Bank have been saying this morning, expected themes likely to be slowing loan growth, sound credit quality and weaker trading income. Now the latter is quite interesting. A lot of investors do look at trading incomes at these types of tier 1 banks very closely. But if you think about it, if we're at record low levels in volatility as defined by what you've probably read, the VIX index, this is very negative for trading activity for these types of banks and institutions. If you think about it most simply, if there's nothing going on in the market and it's seeing very low levels of movement or volatility, then people aren't going to be trading actively, and therefore the bank itself doesn't get to execute many trades on behalf of its clients because they're not willing to enter a market that really isn't doing a lot. And so trading incomes could well be down given these low levels or unprecedented levels of lack of volatility that we've had more recently. So it's something to be aware of. Will these earnings move the market? Well, for those who aren't familiar with the earnings season process, really it's the first big companies to report of their sector tend to be the most watched. The fact that the financials typically come right at the forefront of the earnings quarter as far as the different sectors reporting in the US, it definitely does give you a good insight not only to the banking sector but also just to how earnings season might progress thereafter. But certainly the first couple of big banks, once the first, I'd say 2 or 3 are done, really the rest that come after that are really insignificant from an index futures trading point of view, because the market would have already repositioned itself on the back of the first couple of results to how the whole sector probably would have performed. So that's how I'd look at that. And that's pretty much it. On Spain, obviously it was a bit of a no-show in terms of market activity. Everything following, I guess, as we were discussing, to be expected, a more diplomatic process at the moment. Obviously, PM Rajoy has given the Catalan president until next Monday, 9 AM London time, to formally clarify whether he's declaring independence or not. Because as far as the Catalan president, the day before, he basically said, I guess quite eloquently to balance both sides of the argument, yes, we voted for independence, we're going to do it, but we want to talk first. He has not, though, formally put forward the push for independence. So Rajoy is kind of putting a bit of pressure on, which is then part of the legal procedure if they're going to follow this Article 155 of the Spanish Constitution, which, if invoked, as you know, starts to mean that it's kind of an intervention tactic, if you like, of Madrid to go in and basically seize back control of the Catalonian region. So I'm not really looking for too much of that as a risk for today. I would say probably the weekend's press is going to dominate that, and no doubt the Catalan will come out with something prior to the market open on Monday. But I'll be anticipating that probably more the weekend. So that Brexit talks, I think, a bit of a back burner short term. What I am concerned about today is really central bank speak. We've got Fed, ECB and Bank of England officials. You've also got quite a bit of data coming out as per usual. Anticipation of volatility on the intraday for oil prices on the back of the latest inventory levels, and then we really kick off the big bank earnings. So I'd say be a little bit prudent this morning. Don't get too carried away, because likelihood is the better action is going to come later on this afternoon. All right, going to leave it at that. Any questions, of course, just let me know. Happy to help in the chat room. Otherwise, I wish you all a good day. Thank you very much.